Welcome, everyone, to In the Driver's Seat, the podcast that is all about exploring how to improve the value of your company. We're here to help business owners positioning themselves ultimately for a successful exit. My name is Simon Steed, and together with my business partner, Stephen Kohnke, we co-host this podcast. We're both partner at Denver Business Coach, both certified exit planning advisor and certified value builders. We've worked within the field of exit planning for close to a decade now. We have an amazing team of advisors at Denver Business Coach that have all owned and eventually sold, exited their company. And at the beginning of the year, we were really inspired to launch this podcast to bring this conversation of how to actually build strategically towards an exit front and center to business owners, because we've noticed a few scary statistics that we're here on a mission to reverse. So, Stephen, I'll let you, before we dive into the topic, I'll let you introduce the driving force behind our podcast, and then we'll go from there.
Yeah, so those scary stats that you mentioned are, 3 out of 4 businesses that go to market, and that's selling your business uh, on the open market. And we'll talk about some other ways to do it. But so if you go to market and try to sell your business, 3 out of 4 of you will not sell. And that coupled with 70 to 90% of a business owner's wealth is tied up in their business. That those stats put together were pretty alarming for us, and that's what we're on a mission to change. Helping business owners make sure that they're decreasing the risk in their company, increasing the value, and making sure that they can sell it for top market value.
Yeah. And so in the last episodes, we've spent a lot of time talking about like how do you actually build value in your company? What does a buyer look at? How do you mitigate risk that a buyer could see? And then last week we zoomed into the conversation around strategically defining your end game. We've talked about what kind of an exit do you want to have in your business, by when, also identifying kind of like what your number is that you want or need for a retirement goal or for whatever your next is, and measuring the gap between where you are and where you want to be, and then therefore creating a strategy. And so that's pretty straightforward. I don't want to simplify it. That's pretty straightforward. But what we're going to dive into today is when it comes to exit planning and thinking about how you're going to exit your business, a lot of owners really just have kind of like a limited understanding of what even the options are that are available, right? And it's a little different than selling a house or whatever. So maybe let's zoom in. Like, let's say I'm a business owner. I've owned my company for 10 years. I'm ready to move on to my next. I know I have a sellable company. I know there's value in there. And now I want to think about, okay, what options do I have? What do I even start in that conversation?
I think kind of building off of our last podcast, really understanding what are those 4 questions um, that we need to understand when we're working on an exit strategy. And one of them is, how do you want to sell? What does that look like? And as you mentioned, I think a lot of business owners think selling is uh, where those stats are coming from. It's putting it on the market and seeing who's going to buy it. I think that's a general understanding of how this works, but there's so many different components and options out there for business owners. Like like you said, it's not like building a house or selling a house rather. It's I kind of look at it as 2 generally different paths. It's inside sale versus an outside sale for a business owner. Those 2 different options.
What do you mean when you say inside sales? What do you mean?
So being able to, so I guess like in versus out. So if we're looking at in sales, we're looking at internal into the company. So that's MBO, management buyout. You can sell to, if you have partners in the business, you can sell your share to the partners. There's the ESOPs, employee stock ownership plan, which is internal as well. So it's essentially that inside sale is anyone that's actually working for your company, that you can sell to, get rid of your shares, whether it is a stock or an asset sale. I think we can go into details on those later, but there are different options when you're looking internally to your own staff.
Hmm. So on a macro level, you're saying you can, because one of the things, right, like as someone that's selling, there are different lenses through which I look of what's important to me, right? Like maybe I need a quick transfer. Maybe I
Mhm,
need to maximize the value I want to get out of it. Maybe legacy and
mhm,
continuity is really important to me.
mhm,
Maybe I have family business, right? Or maybe I really care about the employees so there's all these different considerations
mhm,
that come into it. We're like a single family home at the end of the day, unless you're passing it on to you're keeping it within the family and that's the intention. You
mhm.
just want to get the best deal, right? And then you're walking away and you're moving on to the next house. With business, I think there's almost, because there's an emotional attachment there too, right? To people, to the mission, whatever inspired you to start the company as well. So let's maybe explore a little bit, when would an inside sale, meaning a sale to um, your employees or to management or an individual within a company, when would that make sense? What are some of the drivers that lean towards that?
I think for certain industries too, I think it makes more sense than others. I was actually having this conversation with someone in consulting a couple of weeks ago about potential exit options, and in those types of, I kind of call them knowledge transfer industries. Uh, Selling to someone who's already in the company, who's learned the methodologies, who learns the language, who kind of just gets it already, is a heck of a better and easier sale than to try to bring someone outside into, think of a boutique consulting firm. They have their own ways of doing things, very niche. And if someone's already in it and doing it, it's so much easier to do that type of sale than looking outward. So if it continuity is really important, keeping things the same. So legacy is going to play into that factor. Making sure that your staff is taken care of. Doing an inside sale is has a higher chance of that happening as opposed to selling to someone outside the company who's, we've talked about financial versus strategic buyers. They might not necessarily care about that legacy or care about the employees. Not saying they definitely won't, but chances are way higher if you're doing it on the inside side.
Yeah, yeah, yeah. One thing that I can see in, from if you're looking inside your company for a buyout, you definitely, um, I think your point of like knowledge transfer, culture fit,
Mhm,
there's a lot of things that um, can break down, and sometimes there's like this dynamic of like how much of a discount do you have to accept if you're bringing something to the open market, but it's still somewhat owner dependent, or you're still like a key player within it,
mhm,
versus if you're selling it from in-house, you're selling to someone that's inside. You might have greater chance of success or lower discount, but maybe the capital is not necessarily there. So the
mhm,
way you structure the deal might be different, where you have like a longer earnout period, or
mhm.
um, yeah, you might stay attached to the business a little longer for a transition period, for
Yeah.
example.
Mhm,
Um, so so that could be a consideration, like how quickly
mhm.
do you need money, right? Or
Right.
want
Yeah.
money.
Want money, need money. Yeah.
Okay, so that would be looking for the inside, as if it's going to be a cumbersome process. If you have the talent inside and they're able to be able to price you, and you can live with the deal structure, essentially, that's a
Mhm,
great opportunity, right?
mhm. Oh yeah.
And potentially you also save on broker's fees if you go that route. Still, of
Exactly.
course, you want to work with an attorney to get the contracts and everything written up, but at least
Mhm.
you don't need someone to fire you a buyer. Um, and so, okay, so that's an option for an in-house. I know ESOP, we talked a little bit about it right before
Yeah.
this call. It's it's like one of these things we just know enough to be
Yeah,
dangerous, but in as a concept, maybe you can explain it. The technicalities of it obviously are very intricate and probably one of
yeah.
the more complicated structures to set up to facilitate.
Yeah, it's complicated to the point where there are firms that only do ESOPs. And we have partners with a few of them. And if you're in the state of Colorado and this is an option for you, Colorado actually gives some incentives to business owners for doing ESOPs right now. Um, but so essentially what it is you turn your business into all employees have some stock within the business. So you're selling essentially to a trust of which the employees own, and that you have a trustee, and then that trust is paying you. And there's a lot of different moving pieces within there, but the employees own the entirety of the business. There's some really good examples out there of companies that have been really successful of doing ESOPs, and owners are usually really happy when they do ESOPs because their entire team is taken care of. And the from what I've learned, the satisfaction of doing ESOPs is higher for owners because of all those things that they care about, the continuity, the legacy, keeping keeping care of their team. Um, and they can be pretty lucrative too, actually. And there's some tax incentives that come along with it. But outside of that, we bring in specialists.
Yeah, yeah. So we have ESOPs, we have a management, you call it management buyout, right?
Mhm.
Um, so that's internal. And then, of course, we have family transition, which is kind of a little bit of a hybrid because it could be internal if they worked in the company already. Um, what do we have to say about um, passing it on to children or maybe the third generation? Sometimes it skips a generation as well.
Right.
Um,
Yeah, those can be harder. And especially the nowadays, I actually a lot of children don't want the business that their parents own, so it is going to the open market, and that it's a story reason for a lot of those stats, right? Um, where parents think that their kid is going to take over, they don't want anything to do with it. But anyway, to kind of go back to the point here, Exit Planning Institute has a couple stats about family transfers, and I'm not going to get the specific numbers because I don't have them in front of me, but it's somewhere around 65-70% are successful in a first generation transfer, and then it drops down to like 30-40% for a third generation, somewhere in those numbers. And the reasoning behind that, I've had conversations with several people about this, is a lot of the work ethic isn't there. So that's a consideration when you are, someone who's bootstrapped a company and have grown it to a multi-million-dollar company. The kids may or may not actually have that work ethic, and if they don't, that's when it can take a turn.
Yeah, and so ethic, the diligence, right? Like when
Mhm.
you're starting out, you count every penny, you look at the balance, at the
Yeah.
P&L, you're just like in it, making sure it's optimized because it has to be. But at
Yeah.
some point, and that transfer of skill, right? Like I think in family situations, is the next generation, do they have complementary, do they have the same skill, complementary skills? Because
Hmm.
that's still what the company needs. You're still as an owner stepping outside, you're still leaving a gap that needs to be filled within the
Hmm.
company most of the time. Um, it can be a great option if
It
the
can be.
expectations are set. Um,
Hmm. It
it's
can be really easy transition too in some cases. If you have your child working for you for a number of years, it's almost like that internal transfer where they just know and they can take over. There are a ton of, I think there's more risk factors for that than not. Another one that just came to mind is the owner sometimes has a hard time stepping away too. Doesn't know when that cutoff is because it's still family, a part of the family. It's part of the discussion at your Thanksgiving dinner.
yeah,
So they feel like they're a part of it too. So there's a little bit of that oversight component that goes into it.
yeah,
It can be frustrating for that next generation too.
yeah. Okay, so we've looked internally. We've had managed by buyout, we have ESOP, we have passing it on to a potential family member that might have been in the business already. So then let's look outside. I mean,
Mhm.
obviously, I think the one we all know is selling it to a third party,
Open market. Yeah.
open market. All right. So what do we look at when we look at outside buyers?
Um, I think the easiest way to look at an outside buyer is well, first step is the owner operator, right? Someone who's uh, just looking to buy and own a business, doesn't necessarily want to start it, doesn't need um, or doesn't have like hundreds of thousands, millions of dollars to buy a company, just wants something to do. Those are that would be a third party. So they're looking for something that's established that they can work in and grow, right? And those are found on the open market. That's when you would need a broker to come in. Financial buyers kind of moving up, if you think about it as a chain. Owner operators are kind of the first in line, and then financial buyers are could be a group of people, private equity, investment companies, family offices, some sort of investor style person or entity that's looking for a return on their money. So that's for the most part, that's what we're building businesses for. They want the owner independent, systemized, recurring revenue style companies where they can get a return on their investment pretty soundly. Strategic buyers can come into play as well. So think of bigger competition or adjacent industries as well. So though it's essentially anyone outside of your immediate sphere
Mhm.
of your company coming in and saying, I might be interested in buying your business.
Yeah. And then depending on who that buyer is, you're able to maybe get a little bit more money.
Mhm.
One of the things we've talked a little bit about it, like a recapitalization,
Mhm.
where maybe you're at a point where you're looking at retirement, but maybe not quite yet. You still want to run a business for 5 years, but you can bring in someone partially. It could be a majority or
Mhm.
recapitalization, or even someone buying in passively if you can find that, and then have a structure in place where they earn out over time to become a majority stakeholder. But so that's an opportunity that I think a lot of business owners don't really think about as an opportunity. Like I can bring in an investor or a part-time or a partial owner, take some
Yeah.
chips off the table, mitigate some risk. Because a lot, back to our original statistics, all of that wealth that's showing up on a balance sheet is just hypothetical until it's realized. So the closer you're getting to wanting that money tangibly in your hand, like you got to look at how can you make that happen, right? And so sometimes it's an opportunity to bring in an outside investor while you're still staying on as maybe an owner operator, or have some role in the company as well.
I think that's one of the most um, overlooked options or least well known options too for business owners that isn't often talked about. And we all say exiting your business, selling your business, people think of the open market version of exiting, right? And the recapitalization, I think, is a fantastic option for people to kind of slowly work themselves out of the business that way.
Yeah, yeah,
And make money doing it too.
totally. You take some risk off, you get some money
Mhm.
that you can then diversify, take out outside of the business, and still maintain maybe some income generation opportunities, and also keep growing the value of the business
Mhm.
as well. I know I keep going back to the real estate example. Like you don't really see that in real estate so much, where you're like selling 3 bedrooms and keep one or two
Yeah.
for yourself or something. Um, but yeah, great option. Okay, good. So in summary, for our listeners, we've talked about where to look for potential buyers,
Mhm.
inside with some option, outside with some option. What would you say if I'm not sure where to go and I'm still in this process of building my value? Like, how important is it to know what my exit strategy is going to be? when I'm still maybe now 3 to 5 years away from it?
Yeah, I mean, 3 to 5 years is a good period of time to look at what kind of an exit you would want to do. So having those conversations with people around you, I think for the path of least resistance in a lot of cases is an inside sale, and that's where I would start, is saying who in the company would be interested, is kind of has that ownership mentality, is it would buy into to something like that. That could be a good recapitalization, management buyout, a couple other options there. So having that conversation, family members as well, you start with the ones that are close to you, and then if you can build a strategy depending on those responses, those conversations. If no one is interested, then it kind of turns to that third party option, or outside options
Yeah. Yeah.
available to you.
Yeah, I like one of the exercises we do with our clients or prospects is like the with the value builder and the examination of the business, we look at like how ready is the business for the
Mhm.
sale, right? But then we also do like what's your personal readiness
Mhm.
yourself. And I always like to bring up like the push and pull factors. Like what is your next what is pulling where you're wanting to go, and then what are you walking away from, and being aware of it, I think, is the most important thing. So you're like, okay, what dynamics are at play as I'm looking at my exit, and what is important, and based on that, some of these exit options are um, more suitable to solve your your preferences essentially.
Yeah, that's a great point.
And
What
so
is important to you, right?
yeah, what is important to you? And I think maybe we'll dive into that in one of our next
Mhm.
upcoming episodes as
Right.
well. Because I think that's I've had some interesting conversations. Let's just leave it at
Yeah,
that.
we'll bring them up for that one.
Yeah,
Yeah.
yeah. Okay, cool. Thank you, Steven. This was a
All
great
right.
conversation again, and thank you for our listeners to for tuning in. I hope you learned something and took a couple of things away from this episode. I always like our mission and vision is that there's a couple pieces of information or some action steps that you can take. Again, starting to think about what your exit could look like, what is important to you, being aware of what your options are, and kind of going through pros and cons for each one of them. That's kind of what our goal was to explore today.
All right.
So until next time, thank you, Stephen.
All
And
right. Thank you.
guys, next time.
Bye.
Okay.